The government's new Help to Buy scheme lets you enter the property market with just a 2% deposit. Sounds incredible, right? But here's what nobody's telling you. You could be handing over $200,000 in capital growth to the government without even realizing it. If you're watching this, you're probably stuck in that frustrating cycle where property prices climb faster than your savings. So when a scheme promises to get you in the door with $16,000 instead of $80,000, it's tempting to jump at it. I'm Nick from Trellis Finance. I've spent over a decade helping first home buyers navigate these schemes, and right now most people are making the same critical mistake. They're assuming the Help to Buy works like the first home guarantee scheme. It doesn't. Not even close. In the next few minutes, I'll show you exactly how the scheme works using real numbers, who genuinely benefits, and who should avoid it completely, and the single biggest trap I see people walking into it blindly. Let's get into it. First, let's clear up what Help to Buy scheme actually is, because this is where most people get it wrong. Help to Buy is not the government guarantee scheme. The government isn't promising to back your loan if you default. They're becoming a co-owner of your property. Think of this like having a silent business partner who owns up to 40% of your home. Here's how the numbers work. For an existing property, the government takes up to a 30% equity stake. For a new build, they take up to 40%. You only need a 2% deposit of genuine savings. So imagine you're buying an $800,000 new build. Instead of needing $160,000 for a 20% deposit, you only need $16,000. The government contributes $320,000 as their 40% stake, and your loan, just $464,000. Now here's the part that actually works in your favor, and most people miss this completely. Because you're only borrowing $464,000 instead of $760,000, your borrowing capacity requirements are massively reduced. When this is in effect, two buyers want the same $800,000 property. One, using the first home guarantee, needs a borrowing capacity of $760,000. And the other buyer using the Help to Buy scheme only requires a capacity of around $500,000. That's a huge difference. Now, before you get excited, you need to understand the eligibility rules, because this is where I see people trip up. Basically, there are income caps in place. These are up to $100,000 for single applicants and $160,000 for couples. These aren't just guidelines. If you earn $105,000, you're out. And here's what catches people the most. This is assessed yearly. If your income rises above these caps for 2 consecutive years while you're in the scheme, you may be forced to repay the government share. On top of that, other requirements mean you must be 18 or over, cannot currently own property, you must be an Australian citizen or a permanent resident, and you must live in the property as your principal residence. That last point is critical. I've seen clients who wanted to use the scheme to buy, but plan to leave the property vacant or rent it out later. You can't do that. This must be your home. Full stop. There are also property price caps. In New South Wales, it's $1.3 million. In Victoria, $950,000. And in Queensland, $1 million. These caps are slightly lower than the first home guarantee scheme. Now here's where first home buyers get blindsided. It's the single biggest gotcha of this scheme. When you eventually refinance or exit the scheme, the government's 30% isn't based on what you originally paid. It's based on the current market value. Let me show you what that means. You buy that $800,000 property, the government gives you 40%. 5 years later, that property is now worth $1 million. So when you go to buy back that share, you're not repaying the $320,000. You're repaying 40% of the $1 million value, which is $400,000. That's $80,000 of your capital growth going straight to the government. Over 10 or 15 years in a growth market, that could easily become $150,000 to $200,000. Now, you can buy back the government's share in 5% increments, which is called staircasing. But here's what's poorly communicated. The mechanics of how to actually exit this scheme are still unclear. Most people don't understand how it works until they try to do it. And that brings me to this. This scheme puts serious handcuffs on what you can do with your property. If you're someone who thinks of a property as a stepping stone to building wealth, this matters. You cannot rent out the property, not even a room. This has to be your principal place of residence. Refinancing is also heavily restricted. The government holds a second mortgage on your property, and if you want to refinance or access that equity, you need their approval, which may be declined. On top of that, accessing equity for investing is essentially off the table. You can't use this property to leverage into a second property down the track. Even major renovations can trigger issues. If your renovation requires refinancing or structural changes, you may need to repay the government's share entirely. If you're someone planning to buy, live there for the next 3 years, and then rent it out while buying your next place, this scheme doesn't work for you. With all the news articles and headlines floating around on this scheme, it's easy to think this might be the way in for first home buyers, without all the red tape and huge costs. But here's what's really happening on the ground level that the media aren't covering on this scheme. Basically, only 2 lenders are participating at launch: Commonwealth Bank and Bank of Australia. That's it. And here's the kicker. CBA has closed the scheme to brokers. It's first party only, meaning you have to go directly to them to sign up for the scheme. Both of these banks already have long turnarounds. With only 10,000 places available nationally and applications expecting to flood in, you're looking at significant processing delays. Places will probably fill up within 3 to 6 months. What this means is that if you're not prepared before applications open, you'll miss out. Not because you weren't eligible, but because you weren't ready. So let's say you do want to get prepared and be ready to apply as soon as the scheme opens up. First, ask yourself this: will this scheme genuinely work for you? While there is fine print to consider, the Help to Buy scheme is ideal for someone who hasn't saved a 5% deposit yet and wants to enter the property market sooner, has a lower borrowing capacity and needs a reduced loan size, plans to live in the property long term without renting it out, or doesn't plan to use the property as a wealth building stepping stone. If you're a nurse, a teacher, or you work in a role where your income is capped and you're unlikely to breach the scheme's limits, you just want a stable family home, this genuinely could accelerate your entry into the property market. But it's also a bad fit for some. For example, it's not ideal if you plan to rent out the property or move out within 5 years, want flexibility to access equity for future investments, have income that's trending upwards and might breach the cap soon, or see this property as step 1 in a portfolio strategy. So with all that said and done, if you want to secure a spot, here's exactly what you need to do in the next 30 days before applications properly ramp up. First, get your genuine savings sorted. Lenders will scrutinize whether you've actually saved the 2% yourself. Gifted funds or recent transfers won't cut it. Second, understand your borrowing capacity under this scheme specifically. It's calculated differently because you're only borrowing 60 to 70% of the purchase price. Third, get your documents ready. Payslips, tax returns, bank statements, identification. You need to be ready to submit immediately. Fourth, speak to someone who understands the mechanics. The scheme rules are complex, and one assumption can cost your spot, or worse, trap you in a structure that doesn't serve you long term. If you're a first home buyer trying to figure out whether Help to Buy is right for you, or whether there's a better path, we can help model the numbers properly. At Trellis Finance, we don't just process applications. We help you see the 10-year picture so you can make a decision that actually builds wealth and not just gets you through the front door. If you'd like to see how this scheme or other options in the market can help you get into the property space, click the link in the description to book a free strategy call. We'll review your situation, run the numbers, and give you clarity on the best next step. See you in the next one.